Now let's talk about increasing the percentage of winning trades with our option trades. And step 2 in our power trend option trading system is to use what we call the 1% rule to select a call option strike price for a higher percentage of winning trades. And we'll show you how we do that. Once you select a stock for an option purchase, then you must select an option strike price, and depending on the stock, there could be hundreds or even thousands of different strike prices available. So the question is, how do you determine which strike price to use? And option premiums consist of time value and intrinsic value, and each day before option expiration, the time value portion of an option decays. The greatest amount of decay occurs in the last 30 days before option expiration, and at option expiration, options lose all time value and consist of only intrinsic value. So here's a chart of the typical time decay characteristics of an option, and you can see each day the time value portion of the option decays until option expiration, when the time value goes to 0. And most of that decay occurs in the last month. So this is a typical example of the time decay characteristics of options. So options lose all time value at expiration and consist of only intrinsic value. So when you buy an option, you're buying a decaying asset. So you always want to keep that in mind. And due to the time decay characteristics of options, when we buy an option, we want to minimize the time value because it's going to go to 0, and we want to maximize the intrinsic value. So again, our goal is always to minimize time value, maximize intrinsic value, and the best way to do that is to purchase in-the-money options. And in-the-money options have more intrinsic value and less time value than at-the-money or out-of-the-money options. And the way we calculate intrinsic value is we subtract the strike price of the call from the current stock or ETF price, and that will give us the intrinsic value of an option. And in-the-money options have more intrinsic value and less time value than at-the-money or out-of-the-money options. And the way we calculate time value is we subtract the intrinsic value from the option premium, and that'll give us the time value. So we developed a simple technique we call the 1% rule for selecting an in-the-money strike price when purchasing options. And the 1% rule requires that the strike price requires a strike price that limits the time value portion of an option to less than 1% of the stock price. And if you do that, then you'll be minimizing time value, and that's maximizing intrinsic value. So the time value portion of an option has to be less than 1% of the stock price. So let's look at the 1% rule for our XLU option purchase. That we still own that option. And again, on January 31st, we purchased the June 40 strike call at 1480. And on January 31st, XLU was trading at 54.36. So if we buy the 40 strike call, that's an in-the-money call, as it's less than the stock price or the ETF price of 54.36. So bought the 40 strike call at 1480. So using this example of the XLU option purchase, with the XLU trading at 54.36, we would limit the time value portion of the call option to less than 54 cents, which is 1% of the current stock price. So we want to limit the time value portion to 54 cents, which is 1% of the current price of XLU. So again, the current ETF price is 54.36. If we subtract the strike price of 40, we come up with an intrinsic value of 14.36, and the total option premium was 14.80. If we subtract that intrinsic value of 14.36, we come up with a time value of 0.44 or 44 cents. So 44 cents is less than 1% of the 54.36 stock price, so this strike price would qualify under the 1% rule. So the 44 cents time value is less than 1% of the current stock price. Now, in this example, XLU only needs to increase 44 cents for this trade to break even and start profiting. If you limit the time value portion of an option to less than 1% of the stock price, the price only needs to increase 1% in order for the option trade to profit. And a 1% price increase in the underlying stock or ETF to break even and then start profiting, that will have a much higher probability of being profitable than an at-the-money or out-of-the-money strike price that can require up to a 5 or 10% or more increase in the stock price at expiration to profit. So if you buy a at-the-money, out-of-the-money strike, the underlying stock or ETF may have to go up 5 to 10% or more. So if we use the 1% rule, the underlying stock only has to go up 1% and we start profiting. And a lot of times when you buy those at-the-money or out-of-the-money strikes, many times the expected stock price move will not occur before option expiration, in which case you would lose the full premium. So when you use the 1% rule, the value of the option will increase $100 for each 1 point increase in the underlying stock or ETF. And if you purchase an at-the-money or out-of-the-money strike call option and the stock or ETF is flat or down at option expiration, it will result in a 100% loss for your option trade. So we try to avoid 100% losses on our trades. So we use this 1% rule to avoid those kind of losses. Now, when you use that 1% rule to select the strike price, this will increase your percentage of winning trades compared to trading at the money or out of the money strike puts. And this higher accuracy, again, can make you a more successful trader. So this is a simple technique to increase your percentage of winning trades. And we developed a series of calculators for the various option strategies that will calculate the profit potential for an option trade based on the price change in the underlying stock or ETF at option expiration. So we took a look at our XLU option purchase before we took the trade. Again, XLU was trading at 54.36. We purchased the 40 strike call at 14.80. And this call option purchase calculator will calculate the profit potential based on different price changes for XLU at option expiration. In this example, from a 25% increase in price to a 5% decline in price. And we can see if XLU increases 1% to 54.90, at option expiration will have a profit on the option trade. So this verifies that we used the 1% rule correctly, because a 1% increase in the underlying ETF at expiration results in a profit. If we have a 15% increase in the XLU, we'll have a 52% profit potential at option expiration. If XLU is flat at option expiration, we'll have a 3% loss. And we'd rather take a 3% loss than a 100% loss for an at-the-money or out-of-the-money strike price, which would incur 100% loss if the stock is flat at option expiration. And the calculator will also calculate the time value and intrinsic value portion of the option. We can see there's 44 cents of time value, 1436 of intrinsic value. So we use these calculators before we take the trade to calculate the profit potential. So again, in this example, a 1% increase in XLU results in a profit. A 15% increase in XLU results in a 52% return. And a flat stock price equals a 3% option loss, again, compared to a 100% loss for an at-the-money or out-of-the-money strike price. The risk is limited to the cost we paid for the option, and the profit potential is unlimited. And we currently have, in this XLU option trade, we currently have 28.4% open trade profit on this trade. So we have a option trading service that makes trade recommendations for call option purchases. Email alerts are sent out to members with instructions whenever there's a new option trade recommendation, or if we're closing out an existing trade. And we maintain a portfolio of option trade recommendations, both the open trades and all of the closed out trades, so that you can track the performance of every trade recommendation. And we currently, in the option purchase portfolio, currently have a $43,000 open trade profit, average return of 351%. And one of our money management rules calls for us to roll over profitable trades at option expiration if the stock or ETF is still on a buy signal. So in a lot of these options we've been holding for a while, the cost basis has gone to zero. In other words, we roll over the profits at expiration, and over time those profits exceed the cost basis of the new option. So we have a riskless trade at that point with no cost. So that is part of the reasons why the average profit is 351%. And we also provide the 6 option calculators for the different optioneering strategies. We make those available to members of the trading service. If you're interested in seeing how our option strategies are performing, you can log on to weeklyoptionalert.com or give Brad a call, and he can give you information on becoming a member so that you receive these email trade alerts to either open an existing position, roll over an existing position, or to close out an existing position. And you can click, if you go to weeklyoptionalert.com, you can click trade results, and it'll give you open trade results for the various option strategies that we trade.